Within the trading space, Forex and stocks are widely considered to be two of the largest, with both being a good asset in an active portfolio. If someone is to go all in on one type of trading, however, then there are several similarities and differences between the two of them that can make or break the market for certain individuals. Forex generally only deals with the 7 major pairs of currency, whereas the various stock markets have thousands of possible choices. Some people enjoy this freedom of choice, while others consider it dangerous. That's just one of the differences between the two. Market availability. As many people know, the stock market is limited to an exchange's opening hours, meaning that you have to be dedicated to your trading within that time period in order to make profit. Generally, most exchanges in the US open at 9:30 a.m. Eastern Standard Time and close at 4 p.m. Eastern Standard Time. The Forex market, however, is a seamless 24-hour market that doesn't ever close because the currencies being traded span all of the time zones across the globe. Most brokers are open from Sunday at 5 p.m. Eastern Standard Time until Friday at 5 p.m. Eastern Standard Time, with customer service available 24/7. This allows people to customize their trade schedule, which could be good for some. Others enjoy the rigidity of the stock market because it allows them to take time off from their trading after hours. Commissions and fees are another aspect of market availability that have declined in necessity over the past few years. Stockbrokers used to charge large fees or commissions for trades, and many still do. But there are also many online brokers that now offer unlimited trading without commissions. Forex, historically, has always operated without commissions, usually compensating the brokers through the bid-ask spread. Volatility. The last estimation of the Forex market's daily turnover was around $6.6 trillion. This is a massive amount of money, and the stock market sees only a fraction of this. This comes with the fact that there's no restriction on short selling in the currency market, unlike within the stock market. Trading opportunities exist in the Forex market regardless of whether a trader is long or short. And because the Forex market always involves buying one currency and selling another, there is no directional bias to the market. This is unlike the stock market, where people necessarily have to buy in or sell out of the market in order to profit. The Forex market has also historically been far less susceptible to any sort of market manipulation than the stock market. The pulling of political strings can often sway stocks in one way or another, whereas the massive size of the Forex market makes the likelihood of any one bank or fund controlling a particular currency very small. The Forex market is also liquid enough that significant manipulation by any single entity is all but impossible during active trading hours. Market influence. The stock market has historically been quite easy to influence by large funds or even individuals, as their recommendations are often treated as gospel by the average trader. This means that if a stock is declining, all a large player has to say is, "Buy this stock as it falls," and it will immediately begin to shoot up in price as demand increases. The Forex market, on the other hand, is not quite as susceptible to such tactics. Analysts and big players don't have a significant advantage because access to Forex trading is more restricted than access to stock trading. And although it's possible for people to begin mass buying one currency, the amount of it that flows through the market on a daily basis makes the opinion of one fund or individual effectively null. There are many drawbacks and benefits to both stock trading and Forex trading, especially in the realms of volatility and ease of use. Forex is generally a more stable market, but it also could result in less profit due to the absence of major volatility. Volatility is often what creates wealth in an asset in the short term, but long-term stability is, of course, preferable.